You're watching your savings disappear in real time. The number on your screen keeps falling. You refresh. It falls more. And the worst part? This has happened before. Over and over and over again. Every generation, a different crisis. Every crisis, the same gut punch. So buckle up, because we're about to blow through every major market crash since 1900, told from the only perspective that actually matters, yours. We started in 1907 before the Federal Reserve even existed. A failed attempt to corner the copper market triggered a banking panic, and the Dow collapsed roughly 48%. Imagine walking into your bank and finding the doors locked. No bailout, no hotline. Just a handwritten note and empty promises. Gone. Just like that. But that was just the warm-up, because what comes next is the one that haunts every investor's nightmare. The crash of 1929 followed a decade of double-digit annual returns. The Dow rose from about 63 to 381 between 1921 and 1929, a six-fold increase. You felt invincible. Your neighbors were rich. Your barber was giving stock tips. Then October hit. Black Monday saw the market drop nearly 13%. Black Tuesday, another 12%. By mid-November, the Dow had lost almost half its value. The slide continued until the summer of 1932, when the Dow closed at 89% below its peak. Nearly half the nation's banks failed. 30% of the workforce was unemployed. You didn't just lose money, you lost everything you thought the future was. And yet, the market came back. It always does. On October 19, 1987, the Dow plunged almost 22%, the biggest single-day decline in stock market history. Markets had climbed on leveraged buyout fever and junk bonds. Automated portfolio insurance strategies triggered massive sell orders as prices fell, creating a self-reinforcing spiral. You didn't cause this. You didn't even understand it. A computer did it. Welcome to the machine age. Quick question. If you'd lived through Black Monday and watched your portfolio drop 22% in a single day, would you have sold everything or held on? Comment your answer below, because that question might be the most important financial decision of your life. The Nasdaq rose 86% in 1999 alone, peaking on March 10, 2000. Everyone with a .com in their name was printing money. Your coworker quit to day trade. The internet was going to change everything, and it did. Just not the way anyone expected. From that March 2000 peak to October 2002, the Nasdaq lost nearly 80% of its value. More than $5 trillion erased. You stare at the screen. The number doesn't even look real anymore, but at least you still had your house. Right? Wrong. 2008 had a different kind of cruelty. The Dow peaked at 14,164 in October 2007. As the subprime mortgage bubble burst, the most dramatic cliff came in September 2008, following the collapse of Lehman Brothers. The Dow bottomed at 6,469 in March 2009, a decline of roughly 54%. The market took more than 5 years to recover. You lost your portfolio and your home equity in the same sentence. And then, just when you thought the world had learned its lesson, 2020. The Dow hit a record high on February 12th. By March 16th, it had lost 31.7%. The Dow dropped nearly 10% on March 12th, its largest single-day fall since 1987, then plunged another 13% 4 days later. You were already scared of a pandemic. Then your retirement account joined the chaos. But here's the twist. 2020 was actually the least painful major crash because of what followed. The market fully recovered in just 4 months. So what do 1907, 1929, 1987, 2000, 2008, and 2020 all have in common? The catalysts differ: asset bubbles, credit crises, pandemics, but the underlying dynamics of fear, leverage, and herd behavior stay remarkably consistent. And so does one other thing. Every major US stock market crash has eventually recovered and surpassed its pre-crash levels. Every Single. 1. The market doesn't care about your feelings or your timeline. It has crashed before you were born and will crash after you're gone. The only question is whether panic or patience is in the driver's seat when it does. History has already answered that. Now it's your turn. If this hit different, smash that like button and subscribe, because the next video covers exactly what smart investors did during every one of these crashes. You're not going to want to miss that one.